spot month trades some amount of metal that gets asked for delivery the next day. This never happened before. You and I have been around this. There were never any deliveries. Now
Right.
there's massive deliveries all the time.
Right.
And who's buying it? Well, I presume that they just have to buy it to cover their damn short. Silver, as Michael says, is probably going to go to 50 very quickly here, 3 to 5 months. It can blow through here. I've never believed in the 100-to-1 ratio between gold and silver. Ever believed in it. Why did that happen? It's produced 8-to-1. It's in the Earth's crust, something like 10-to-1. Historically, as a currency, was 15-to-1. Why is it at 100-to-1? Why was it at 100-to-1? Because someone was manipulating it and suppressing it, because it's a very important metal, silver. Very important.
The silver market is beginning to fracture under the weight of its own suppression. Every single day on the COMEX, metals are being demanded for physical delivery in unprecedented volumes, an anomaly that until recently was almost non-existent. This signals something critical. Paper silver is being aggressively converted into physical bullion, likely as short positions are forcibly unwound. Today's analysis centers around Eric Sprott, Canadian billionaire, legendary precious metals investor, and founder of Sprott Inc, whose decades of experience in navigating manipulated markets make his perspective uniquely valuable. Sprott warns that the historically unsustainable gold-to-silver ratio, which has lingered near 100-to-1, is nearing a violent correction. Based on production ratios of 8-to-1 and silver's multifaceted industrial and military demand, particularly in a world of escalating conflict, the market is primed for a radical repricing. According to Sprott and technical analyst Michael Oliver, silver could surge to $50 within the next 3 to 5 months, and potentially even higher. This isn't a speculative fantasy, it's a structural inevitability. The daily drawdowns on COMEX inventories, the record-high short covering, and the long-term physical shortages all point to one conclusion: silver's artificial ceiling is about to shatter. Before we dive in, don't forget to like, share, and subscribe for more deep-dive financial analysis and insider perspective. Hit the notification bell so you never miss a critical update on the unfolding metals market reset. We appreciate the support and hope you enjoy the video.
When I review my time with the gold space, I actually say, look, I started this in 2000, exactly at the bottom of gold, okay, because the market was about to crash in NASDAQ, and I got into gold stocks. And I said, and I've had to fight the manipulation for 25 years.
Yeah.
And it ended in gold at 2000. And I think it's over in silver now at $35. Now that we're at 37. So it's been a 25-year fight. We all know about the guys messing around in COMEX, and the fact that, you know, the COMEX price of gold would probably, if you just traded COMEX every day, they'd probably be about $100 an ounce.
Right.
But if you traded out of COMEX, it'd probably be 50,000 an ounce. It just tells you what's going on, right?
Yeah.
Well, as you know, I'm a disciple of Michael Oliver's at MSA Consulting. And I think he's been so right on what to expect in the metals. And he was so good on gold and the gigantic move we had. And of course, he's been pounding the table on silver, that silver is going to, you know, break through 35. When it breaks through 35, it's going to be a run of, 3 to 5 months to get to 50, potentially 60 and 70 this year. So even from here, let's take his upside target. Oh my God. If silver ever went to $70 and the average silver producer's $20 cost, which is high, he's making $50 an ounce of silver. Do we know how much these stocks are going to go up by?
Yeah.
Because at $25, the guy probably didn't even make $5. And now he's making 30. He's making 6 times as much. Or at $70, he's making whatever that is, 800% more money. So, like, it's just mind-boggling things that can happen. If you make 800% more, your stock can go up 800%. Your stock could go up 800% in a year if it went to 70.
Yeah.
And it's the same with the gold. Every time I look at a gold producer, I think, oh my God, the little ones, it's trading at 1 times next year's cash flow. One. When's the market going to catch up to this? And when I look at these stocks, when I look at any stock these days, if somebody told me it's going to go up 5 times, I say, well, I'm not interested in that. I want a 10 bagger or a 20 bagger. And of course, I'm assuming the prices go up and stay up. And even in the case of gold, I don't even have to assume they're going to go up. They're already up.
Right.
You know, when I look at the difference in margins today at $3,400 gold versus 2,000, it's stunning. He's probably making 15 times more profit. 15. And the stocks really have not reacted as wholesomely as they could and will do because people are just starting to focus in on it. It's the one best performing group for sure. I think I read that the weighting of stocks, gold stocks in all portfolios, is like 0.25%. Okay.
Right.
And somebody
Right.
saying,
Right.
well, maybe you should have. And by the way, I have 90%. Okay. Just so everybody knows. And that percentage is going up fast these days because my cash ain't giving me nothing. And I don't have much cash, needless to say, but, you know, but somebody's saying, well, you should have 2% in gold, which of course is a flimsy little participation. To get 2%, quite frankly, the stock's got to go up 8 times because there's probably hardly any net new issuance because yes, the smaller companies are doing issues. The bigger companies are buying their shares back. And they're probably spending more money buying the shares back than the little companies are raising money because they're cash flowing $1 billion a quarter. And they all got stock buybacks and dividends and things like that. So anyway, I'd say it's the pool of stocks is shrinking. And we want people to have 8 times more in stocks. Well, how the hell are you going to do that? You got to drive the price up by 8 times.
Yeah.
That's to get to 2%, when the average guy should be 10 or 20%.
And I track the commitment of traders every week. Since February, the rally has been driven by commercial short squeezing, by commercials buying. The speculative position has been cut in half. It's the commercials that have been driving it by covering their shorts. There's thought now the same thing, we might be on the brink of that in silver. What do you think of that?
Yeah. Well, I think we are. And I do believe that it's been manipulated for the last 40 or 50 years. We see that. We know that 8 banks have most of the shorts. Well,
Yeah.
why banks? Why only 8? Why that big? I mean, there's no logical reason for it other
Right.
than it was a market that they could mess around in because of their sheer size and working together. And now they realize that, which they saw happen in gold. Oh my God, people really want to buy this stuff, and they're buying it from us, and we don't have enough gold anymore. And we all know that in silver we've had a 200 million ounce shortage for the last 4 years. We'll have one again this year. People are taking gold off the COMEX and silver off the COMEX every day on the COMEX. Every day, the spot month trades some amount of metal that gets asked for delivery the next day. This never happened before. You and I have been around this. There were never any deliveries. Now there's massive deliveries all the time.
Right.
And who's buying it? Well, I presume that they just have to buy it to cover their damn short. So I think silver, as Michael says, is probably going to go to 50 very quickly here, 3 to 5 months. It can blow through here. I've never believed in the 100-to-1 ratio between gold and silver. Ever believed in it? Why did that happen? It's produced 8-to-1. It's in the Earth's crust, something like 10-to-1. Historically, as a currency, was 15-to-1. Why is it at 100-to-1? Why was it at 100-to-1? Because someone was manipulating it and suppressing it. Because it's a very important metal, silver, very important, particularly for the military. All those missiles that are being firing off around the world, they consume a lot of silver. And there's so many other uses. There's no sense me going into it. Everyone knows about that. But I think we're in a shortage situation in silver, and God knows how high it could go. If Michael's Oliver, I think his target on gold is 8,000, the way outside target. Well, if you went to 15-to-1, what would that be? Like $200, $400, something.
Eric Sprott's testimony is not just about price projections. It's about the unraveling of a decades-long campaign to suppress precious metals. Since the early 2000s, he's been fighting what he openly calls a manipulated pricing regime. From gold's $250 low to over $2,000 today, he's watched the slow erosion of this financial theater, and now sees silver at the same inflection point. As of mid-2025, the commitment of traders data confirms his claims. The rally in silver has not been led by speculators, but by commercial short covering. the banks themselves scrambling to get out of positions they've managed for over 4 decades. With COMEX facing a consistent 200 million ounce silver deficit annually, and with 8 major banks holding most of the short interest, this is no longer sustainable. At the same time, silver equities remain vastly underpriced. If silver surges from $25 to $70, miners could see their profits rise 800%, a level of margin expansion rarely witnessed in modern capital markets. In that scenario, a 10-bagger or 20-bagger return isn't theoretical, it's plausible. Despite this, gold stocks still constitute just 0.25% of institutional portfolios, far below the 10 to 20% allocations Eric recommends. A rebalancing would require a massive price increase to achieve even a 2% weighting, an explosive setup for revaluation. Let's get back to the video.
Do you sense there's any, call it mainstream involvement in the precious metals yet?
I'm pretty certain they're looking because, and I've said this many times to you and then your listeners, if every day the computer spits out and says the best performing group was precious metals, next day, precious metals, after a while, even the analyst who's reading this, and well, what's with this precious metal stuff here? The fact that, I don't even, is silver up 50% this year and gold's up over 50%, something like that. I don't know what the hell the numbers are, but big numbers, okay, in a rather difficult stock market. And they will all come around. We see it now in one sense. When there are issues done for these smaller companies, they're very well subscribed, if not massively oversubscribed. So they're out there, okay, looking in. And when it comes to the metals, you know that the metal supply of gold only goes up 1% a year. One.
Right.
How the hell does somebody, come in and buy more gold when there's only 1% more gold that year? You don't get many guys in, okay? And as I just went through with the stocks might not even be growing, the number of shares that you can buy. They might be shrinking. So it's not easy to get in. And that's why one can imagine we could see like outer worldly gains here. We've already seen it in lots of stocks, okay? I can't believe the number of times. Oh, gee, I think I have shares in that company. Let's go look and see what it's doing. Oh my God, it doubled. Some name I haven't even looked at in 5 years. And in the last 2 months, it's doubled, right? And I can see why people are going there because people are getting interested in all kinds of metals too. Platinum, palladium, rhodium, I hear about gallium, copper, germanium, all kinds of copper. I mean, there's a move to get into these things. So it's a great time for us right now. And I think we'll have lots of days in the sunshine. I don't even like to think about the real silver shortage we might have, the world might have. I don't even want to think about it. It's a problem. Things can stop without silver. We've already eaten through 800 million ounces of above ground inventory. We don't have that much more to go. And I wouldn't be surprised that maybe even the governments nationalize the silver, not the mines. They shouldn't nationalize the mines because you need entrepreneurs to run mines. But, they might say, okay, we got to take all the silver back. And just like they confiscated the gold, maybe they'll confiscate the silver. Who knows? I don't know. But, we're just running things in the ground economically here, these governments and their ridiculous fiscal policies. It's just ridiculous what we're doing. And you got to pay for that stuff, right? There's so many burdens on people that they have to fund this machine, this spending. Oh my God, it's just crazy.
What an important month the next couple of days are going to be because we stand on the precipice of maybe the highest monthly close of all times, maybe even the highest quarterly close of all time. The significance of that for price. What do you?
I should have warned people of something. The calls that are in the money. Calls that are in the money on SLV are monstrous.
Yes.
Now that's not a good thing. Yeah. That's not a good thing, okay?
Right.
Because the guy on the other side of it is the banker, okay? He's going to work to get that thing down for June 30th, okay? It's quarter end, but he's got so much money on the table that if this silver thing keeps going up, he's going to be in big trouble. I think we might have 100 million shares of calls on SLV expiring on the 30th of the month. So it could be wild and crazy.
What we are witnessing in the silver market today is nothing short of a systemic rupture. After decades of deliberate suppression, orchestrated shorting, and distorted price discovery mechanisms on platforms like the COMEX, the physical realities of the silver supply chain are now colliding with the artificial structures of the paper market. And according to Eric Sprott, one of the most seasoned and respected voices in the precious metals sector, this long-awaited reckoning may finally be underway. Let's consider the fundamentals. Silver has recorded a 200 million ounce supply deficit each year for the past 4 years. That's 800 million ounces of unmet demand, consumed without replenishment. This year, the deficit will continue, despite rising prices, because there simply aren't enough producing mines or above-ground inventories left. According to data from the Silver Institute, total global production in 2024 was under 1 billion ounces, yet industrial demand alone exceeded 1.2 billion ounces, driven by the expansion of solar, electric vehicles, and military-grade electronics. More critically, the daily withdrawal of physical silver from COMEX vaults signals a structural shift. These aren't speculative trades. These are direct, high-volume purchases for physical settlement, often by entities with urgent industrial or strategic needs. This has never happened at this scale. For decades, COMEX operated on the assumption that physical delivery was the exception, and behind these drawdowns are the commercial banks themselves. Sprott points out that the massive short covering by commercial players, not speculators, is driving the current rally. In other words, the same entities that suppressed the price for decades are now trying to exit those positions before the fallout. This is the institutional equivalent of a fire drill. Meanwhile, the gold-to-silver ratio remains wildly disconnected from historical norms. Silver is mined at an 8-to-1 ratio to gold, exists in the Earth's crust at approximately 10-to-1, and historically traded as currency at 15-to-1. Yet, in the manipulated futures markets, it still hovers near 80-to-1. If that ratio merely reverted to its long-term average, and gold were to hit Eric Sprott's outer range forecast of $8,000 per ounce, then silver would need to reprice above $500 per ounce just to stay historically aligned. Mining companies currently producing silver at $20 per ounce could see profit margins increase by 800% or more, according to Sprott's estimates. That margin expansion translates directly into stock price appreciation. In this scenario, so-called junior miners, currently trading at a fraction of intrinsic value, could deliver 10-bagger to 20-bagger returns as capital floods into a sector still representing less than 0.25% of total institutional portfolios. To raise that allocation to even 2%, a modest hedge, would require a 700% to 800% revaluation of available equities, given the lack of share dilution and persistent buybacks among the larger producers. But silver's investment thesis isn't merely about price, it's about access. With only 1% annual growth in global gold supply and flatlining silver production, physical acquisition becomes a zero-sum game. This leads Sprott to raise a chilling possibility: government intervention. Just as the U.S. government confiscated gold in 1933, he speculates that authorities may eventually move to nationalize strategic silver inventories, not necessarily by seizing mines, but by commandeering above-ground stocks. That would include ETF-held silver, private vaults, and possibly even industrial stockpiles. The urgency intensifies when viewed against the backdrop of macroeconomic policy. In just 1 month, May 2025, the U.S. government added $316 billion to the national debt. This trajectory is unsustainable, and markets are beginning to recognize that the only viable hedge against sovereign default risk and fiat debasement is tangible monetary metal. That's why institutional players, despite their historical indifference, are now starting to pay attention. As Sprott notes, when every week the best-performing asset class is gold and silver, portfolio managers start asking questions. Already, small-cap mining deals are being oversubscribed, and microcap stocks once ignored are doubling in price within weeks. We are still in the early innings of this reallocation, but as access to physical metal tightens, latecomers will face premiums, delays, and eventually, exclusion from the market altogether. And then there's the elephant in the room: derivatives exposure. According to Eric, there are up to 100 million SLV call options expiring at the end of this quarter, a colossal number. The counterparties to those contracts are major banks. If silver prices continue to rise into month-end, these banks could face unprecedented losses, forcing them to cover positions or suppress price via market interventions. If they fail, we could see the largest gamma squeeze in silver's history. In closing, this isn't just a bullish setup, it's a warning. Physical silver is vanishing, the paper market is unraveling, and the monetary system is imploding under the weight of its own excess. The illusion of abundance is breaking down. Those who have ignored silver as a monetary asset are running out of time to reposition. Eric Sprott's insights come not from theory, but from lived experience. 2 decades of battle against entrenched financial power structures. If he's right, and the markets are finally allowing the true fundamentals to manifest, then we are standing on the edge of a historic repricing event. One that will upend conventional investment logic, reset asset valuations, and force the world to rediscover the intrinsic value of real, unforgeable money. If you're watching this, you're already ahead of the curve, but staying ahead requires action. So make sure to like, share, and subscribe to this channel. Tap the notification bell to get alerts as we cover the unfolding truth behind the precious metals market. What do you think the real price of silver should be? Could we see a $500 silver market? Drop your thoughts in the comments below. Your perspective matters more than ever. Thanks for watching.